Hello. Thanks for having us here at the Connecticut Conference on Climate Change. We're super excited about being here. Brief introduction on my side. My name is Jigar Shah. I'm the director of the Loan Programs Office. And with me is my partner in crime, who's the head of our risk division, Andrew McCabe. If you want to introduce yourself, Andrew.
Yeah, thanks, Jigar. Andrew McCabe. I am the Chief Risk Officer, Director of the Risk Management Division of the Loan Programs Office here at the Department of Energy, and super excited about being here as well with the Connecticut Conference on Climate Change and Insurance. I'll go ahead and just start us right off. We're going to ask some questions of each other and challenge each other a little bit. Hopefully on this Friday, we have everything wrapped up. So what role, Jigar, what role has LPO played and can play going forward in addressing climate risk?
Yeah, look, I think that, at the very top level, the money that came out of the Inflation Reduction Act is, depending on which numbers you believe, is, let's call it, $370 billion. And it's supposed to inspire $10 trillion of investment, right? And so by definition, the Loan Programs Office is in charge of making sure that the first of a kind projects get deployed, the engineering excellence projects where the EPC companies do the second, third, and fourth projects. We want to, keep funding incremental innovation as the costs come down. And then finally, we want to help Wall Street really do the first securitization so we can get full Wall Street acceptance. And when you look at our track record, we're the office that supported Tesla, which today, of course, has inspired, I think, every automotive entity in the world to embrace electric vehicles fully. And so we played a very small role in that, but clearly Tesla played the much bigger role in that, but we're very excited for them. We also put the first $5 billion into utility scale solar and utility scale wind projects in this country in the 2009 to 2011 timeframe. And many Wall Street banks will say that they would not have provided senior debt to that asset class if it hadn't been for us going first. And many insurance companies, of course, are also invested through their funds into these asset classes. And so when you think about what it means to build a bridge to bankability for these assets, the Loan Programs Office is the main tool by which the commercial banks and others get comfortable with these additional assets. And when you think about where we are today, we probably have electric vehicles, solar, wind, some geothermal, some lithium-ion batteries that are fully market accepted. But there's another 20 sectors to go. You got sustainable aviation fuels, you got nuclear, you got, next generation transmission technologies, hydrogen, carbon sequestration and storage, and the list goes on. And we've got, 90 some billion dollars worth of loan requests into the Loan Programs Office across 91 applications that are active. And so that's roughly $1 billion per application in the office. And so we've got another pretty steep hill to climb. So I think that's probably on the first side of things. The second side of things, though, is that, our loans are probably 25 to 30 years in length and at maximum, and some of them are shorter. So, the security of our projects matters, in terms of, is that location in the middle of a floodplain? Is it likely to get flooded out regularly? Is it going to be affected by sea level rise? Are we going to have some of these other issues? And clearly we can't protect every single project from, a hurricane or a tornado or something.
Sure.
But we do have to think long term about these assets. We're managing, roughly $30 billion worth of projects now in our portfolio management group that, are probably 10 years into their loan and probably have another 10 years at least left on those loans. So, I think there's a lot of reasons why, we need to be cognizant of climate risk, both on the macro and the micro. So But at this point, Andrew, I'll flip the script over to you. You're LPO's chief risk officer. Can you talk to us about how LPO assesses climate risk?
Sure. Thanks for that. Let me talk first about the overall LPO context in both addressing and assessing climate risk. Throughout its history, LPO has been about enabling those technologies to allow for more efficient and less polluting generation and use of energy, whether deployed into innovative vehicles, as you pointed out, or through advanced power plants and infrastructure. Our Title 17 projects, as you'll see if you visit us on LPO website, must avoid, reduce, or sequester greenhouse gases. And our ATVM program is Advanced Technology Vehicles. Manufacturing program is similarly explicit in its requirements that finance projects use a lot less of the stuff that produces greenhouse gases. The just launched, and this is a mouthful, Carbon Dioxide Transportation Infrastructure Finance and Innovation Act Loan Guarantee Program, we know it as the CFIA program, supports carbon capture, utilization, and storage technologies that helps haul the bad stuff away. And the context here is that LPO addresses climate risk by going way past acknowledgement and invention phases, if I can call them phases, to the tangible support of decarbonization technologies through the provision of debt capital. So assess and mitigate and lend when there's a reasonable prospect of repayment. The business of assessing climate risk here is reviewing new prospective loans and loan guarantees and our existing portfolio for their roles respectively in decarbonization. How might these loans help promote the reduction in climate-related risk events? And also important to note, just as it's almost an aside, but not really for our audience especially, is our ERM team also assesses known risks to which LPO itself is exposed. And just for good order's sake, of course, we do report that up to DOE's Office of the CFO yearly. So on from the LPO context to the degree to which projects themselves are exposed to climate risk. And so how do we do that? And Jigar, feel free to chime in or.
Well, one thing I would say before we hit that topic is just maybe describe all the additional authorities we have, right? So when we came into office, we came in with $40 billion of remaining loan authority. So that's across, as Andrew suggested, Title 17, the Advanced Technology Vehicle Manufacturing Program, and the Tribal Energy Loan Guarantee Program. The Inflation Reduction Act gave us an extra $100 billion of loan authority, roughly, across those three existing programs, right? So $40 billion for Title 17, $40 billion for the Advanced Technology Vehicle Manufacturing Program, and then increased the Tribal Energy Loan Guarantee Program from $2 billion to roughly $20 billion worth of loan authority. In the bipartisan infrastructure law, we got this program called CFIA, which is to fund CO2 pipelines, particularly trunk lines that might be common carrier. And so there's a tremendous interest there, and that's probably $25 to $30 billion worth of loan authority. And so we're busy there. The bipartisan infrastructure law also expanded our existing authorities to cover more sectors. So the Advanced Technology Vehicle Manufacturing Program was originally just passenger vehicles, but today it also includes heavy trucks, medium-duty trucks, airplanes, locomotives, maritime, and even the Hyperloop. So if that becomes a real thing, then it'll cover that as well. And so, that's a lot of work. It also expands our remit in critical minerals in Title 17. And so that's great. And then gives us the ability to access the federal financing bank for the Tribal Energy Loan Guarantee Program, where previously we were only able to provide guarantees to banks. The last new program that we got was the 1706 program, which is within the Title 17 family. And that really allows us to help with existing energy assets, right? So it's called the energy reinvestment program. And that allows us to take existing coal plants, natural gas plants, and help them make the transition to becoming useful assets for the next 60 years. And so that includes getting property taxes to continue to get paid to local towns, as well as keeping a lot of the workers employed that are there now. And that extends not just for those power plants, but also for all electricity infrastructures. That includes transmission lines and others, but also includes things like nuclear plants and helping to repower or extend the life of those nuclear plants. But then it also includes the petroleum supply chain. So things like tank farms or refineries or old pipelines that are currently being bypassed because more pipelines have been built. And so there's a couple of applicants that have come in where that particular natural gas pipeline or oil pipeline is no longer essential, and they're going to repurpose it for CO2 or hydrogen or ammonia. So a lot of new authorities, and that authority, the way that one works is we provide loans at U.S. Treasuries plus 0.375 of a percentage point, and then we might have a risk-based charge on top of that. So pretty attractive rates, and then we can go out, probably 30 years. And then we pay the credit subsidy on, above a certain interest rate. So if you have really risky projects, we pay for the points on the loan, as you were. And we have $5 billion to pay the points on the loan. And so once that $5 billion is out, then we run out of authority there. And I'd say even in the riskiest of projects that we would be willing to underwrite, that number doesn't usually get above 10 or 12%. And so even if we only do risky projects, that $5 billion probably translates to $50 billion with the loan authority. And then if we do a lot of low risk projects, then it can be much higher, with a cap that Congress has put on us of $250 billion. So we'll see whether we hit that cap. But we're excited about all these new programs and getting the private sector, frankly, to apply for them all.
Yeah, so that's definitely the LPO context. There's a lot of context, a lot of programs there, and a lot of new authorities. So we're all busy from originations to risk, and moving onto the climate risk, and to the degree to which we look at climate risk and how do we assess it, and what do we do with that? Well, we look around, we look for best practices. We look at our colleagues at Standard & Poor's, credit rating agency, and our SRO. They use 4 criteria in assessing projects: physical risks, climate transition risks, natural capital, and waste and pollution. And physical risks are those risks that are directly related to climate, right? So susceptibilities to drought, like Jigar mentioned. We've got up to 30-year loans here. We have to look at those risks: sea level rise, flooding, seismic activities, windstorms, et cetera. Climate transition risks, another bucket, is the project's exposure to potential future climate-related changes in regulations, changes in consumer demand patterns. Natural capital, does the project depend on non-renewable, scarce materials or hard to obtain renewable ones? And thinking also about the impacts on the environment in obtaining these materials. And then the fourth S&P bucket, if you will, waste and pollution. Do the projects themselves, are they subject to or even cause pollution themselves? Factors, are there factors that bring out waste products, wastewater, or other pollutants? We do have teams that have looked at this. It's been pretty much in our DNA since day one. NEPA reviews, our engineers looking at the wastewater and the treatment and in the permitting process. But we're bringing it out over the last 10 to 15 years. It's really the climate related risk, ESG, has really come out and is really developing, as I'm sure this audience is very much well aware. Fitch, another credit rating agency, introduced ESG relevance scores, which I thought was interesting, because in some projects, they might not be as relevant depending on the type of loan. The point here is that there are growing numbers of other reputable guidelines for mapping in environmental factors, such as MSCI. They produce indices, the debt indices, UN principles for responsible investment, the Government Finance Officers Association, and most, if not all, other credit rating agencies are looking at this. And getting to LPO, we incorporate a montage of these, and we also have our own lessons learned. As we've said numerous times, we have we're buy and hold largely, and we have one of the largest innovative innovative energy debt portfolios around. And so we've learned a few things as we've gone through this. Ensuring our own portfolio managers share these observations that they've gained with our new transaction teams is pretty critical to our operation. Just as an example, the fires and droughts in the western half of the country have certainly been on our minds. Historically, at least, LPO has been predominantly buy and hold, as I mentioned. And so we do get to know the point is we do get to know our credits pretty well. We also have, just because we're Department of Energy, national labs. We have, as I mentioned, our engineers, in-house engineers, NEPA review staff. And so we're pretty well staffed to handle and manage and assess and mitigate climate risk as we originate and on the run with the existing portfolio. What do we do with this information? Just more on kind of that montage, screening and scoring, integration of the E and ESG. That was a subject of an internal study that we did in February as to how to do that most effectively. We have, just like credit rating agencies, risk matrices that we put loans through as we evaluate the risks of transactions. The presence of climate risks can translate into, say, a higher debt service coverage ratio or the need for special reserve. We consider the science with our staff engineers, who are some of the best in the business, best in the world, and ask the what ifs. And in some instances, our risk group will go back and ask for additional stress cases to be run by transaction teams accounting for climate risk observations. What happens, for example, when a solar facility suddenly would have no water on site? Climate risk translates into other risks that I would say, quote unquote, traditional matrices catch. Lack of water, for example, is an operational risk. These changing views can adversely affect regulatory and legal risks for sure as well, just different traditional risk categories that we've looked at. But again, we're really trying to bring the E out on ESG here because of changes in the world. The focus on climate risk has changed, driven in part by the climate events, as I'd mentioned them. I haven't studied them extensively, but I think this group would appreciate that these 100-year weather events seem to be happening a lot more frequently lately. And that's meant to be my kind of a probabilistic joke, attempted humor. And also, Fitch pointed out recently in a white paper, the inverse relationship between credit default swap spreads and ESG scores. So investors are really looking more at ESG as a tool to identify risk, which helps make LPO programs more interesting, I think. And with that, Jigar, let me pass it back to you with a question.
Sure.
What role can the insurance industry play in addressing climate risk, and what synergies are there between LPO and the insurance industry, do you think?
Yeah, no, it's a great question, and one that, look, I think the insurance industry has played a very key role in this area for a very long time, starting with our friends at Swiss Re and others who've been working on this for 15 plus years, but then many of you in this room who have spent a lot of time thinking about how you insure against many of these risks. And so that, I think, does tend to play into, how we should build infrastructure. The other area, though, is also around your investing side of things. Insurance companies have long invested alongside of LPO and others in energy projects. And I know John Cancock played a pretty big role in a lot of our projects in our first phase from 2009 to 2011. And I think from what we're hearing in the news, many insurance companies are looking to expand their risk profile to try to get higher yields today. And so when you look at who has the best track record in the industry today? That's probably us, right? And so when you think about all the early stage things that we did back in 2009 to 2011, we did things that, most folks thought were risky. But in the senior debt tranche, we were able to, really have a loss rate of roughly 3.3%, which is really low.
Absolutely. Yeah.
And when you think about how much money we've made for the government, there's a couple pieces here. One is that we earn roughly $533 million of interest per year. We've collected roughly $4.2 billion worth of interest payments so far in our portfolio, with $1.07 billion of losses. And we've got another, 10, 15 years left on our average asset. So, you can imagine there's probably another $5 to $7 billion coming in of interest there. So I think the returns have been quite good. I think the losses are frankly in line with where most commercial portfolios are. And so part of what we're seeing is an interest from the insurance industry to co-invest alongside of us. We have a dual process where we have a conditional commitment that we provide first to our applicants, which is basically a glorified, 35-page term sheet. And then we actually then have the closing, which is them closing all of the conditions precedent, but also, the legal documents with us. And so between those two time periods, the existence of the applicant becomes public. And for many of our applicants, they've said, look, actually, once we go through this process and have the stamp of approval from the Department of Energy, they'd be interested, even if it's at a slightly higher interest rate, to bring in maybe half the debt from, the insurance industry or others, so that those industries are doing due diligence on the deals and actually coming in to these projects. And it provides that bridge to bankability to the next projects that this developer invariably will have to build. And so getting the attention from and the respect of, these institutional investors, which the insurance companies are clearly at the top of the list, is very important. I'd also say that there are some very specific risks that we're taking that an insurance industry might be able to insure against. We're not really allowed to buy insurance to take care of those risks, but our applicants are. For instance, many of our projects have merchant risks alongside their projects, whether it's on hydrogen or whether it's on carbon capture or other things. And you could imagine insurance products being available to help collar some of those costs in the marketplace. So we're pretty excited about that. So my next question for you, Andrew, is that, we're just one loan program within, the federal government ecosystem. I'm curious, you work with a lot of your colleagues throughout the U.S. government. Maybe talk a little bit about the governance structure we're under with, with FCRA, which I always forget what that stands for, and then all the other lending institutions, as well as the role the Office of Management Budget plays, and some of these connective tissue maybe with some of our brother and sister lending agencies.
Yeah, sure. So as you know, Jigar, I've had previous experience with Ex-Im Bank and WIFIA, which is the EPA program, and their experience is similar, where they see themselves as serving as having a multiplier effect, where they'll bring in capital, but they're supporting industries. In the example of WIFIA, supporting the necessity of modernizing our water infrastructure programs in the United States. Ex-Im supporting exports and basically acting as an engine to spur on business, to further commercialize business. We're at the earlier stage of commercializing business. But in terms of the overall federal credit infrastructure, I mean, we have a substantial amount of loan authority and the multiplier effect, which Jigar talked about. The Office of Management and Budget works with us. They are the overseer of credit subsidy calculation, which is in effect the cost to government of cost of carry of these loans to government. And so we work hand in hand with our partners there. Treasury as well has a role with some of our programs, and obviously as a provider of the financing through their federal financing bank through because we don't have the actual bank within Department of Energy. There's no teller window here that we work with Treasury, and they also provide some insight onto the risk that we undertake on certain of the transactions depending on the program. But I think that answers the question. We have a very large infrastructure here supporting basically the administration's goals to decarbonize the economy and on the 4 pillars schedule. And it's growing. We're united through several pieces of connective tissue. That sounds disgusting. I should figure out how to say that a little bit better. But Federal Credit Policy Committee unites different elements within Washington, the federal credit community. So we have contacts with our colleagues on how best to address risk across government in USDA, and expanding out to farther reaches such as HUD, the DFC, former Overseas Private Investment Corporation, transportation, and commerce. Commerce has a new program very close to our programs, or some of our programs, called the CHIPS program, and they've got some new authorities that they're looking to deploy. So it's a growing business beyond the shores of LPO, but the risk managers here are talking and trying to divine the best practices in conjunction with industry, in conjunction with our credit rating agency colleagues, how to assess and contend and manage climate risk and incorporate it into the risk matrices. And not just, I think the point is it's not just at LPO, but across federal credit. And there are going to be opportunities for insurance. There's nothing more exciting to a risk manager, Jigar, than hearing risk sharing. And growing the opportunity to not be the only one in the room financing a specific technology. As exciting as that is, it is challenging work, but one that we embrace every single day here at LPO, and moving that bridge to bankability so that our country does well by innovating and reducing greenhouse gases in the mean as part of a very happy outcome. So back to you. Did I answer?
Well, I think we're almost here at the end of our time, so I'll maybe just close out. I'd say that, look, in general, the insurance industry is at a very important place, I think, with the hurricanes in Puerto Rico and Florida. And when you think about, some of the other natural disasters in the West and drought conditions, I think that the insurance industry has been predicting a lot of these things for the last 15 years and asking, government to do more. We have finally done more with the Bipartisan Infrastructure Law and the Inflation Reduction Act. And now we've got to figure out how we practically get things done. So when you think about the role that that insurance plays in this whole thing, it's actually pretty important. So when you think about new policies that you're renewing, or existing policies, that you're renewing, you could imagine getting building owners to use all of the rebates and incentives that come in these programs to improve their building and make them more climate resilient will be critical. And hopefully you guys will reflect that in the insurance premiums you charge. But the same thing is true for, housing, and whether the housing is in floodplains or not, and, how we help people, make better decisions as to where to invest, some of their, biggest asset and liability. But then I would say the last piece of it is that, it's the money that we're putting out the door needs to inspire $10 trillion of private sector investment. And a lot of that investment is going to come from the insurance industry and some of your colleagues in the institutional infrastructure industry. And I would say that outside of a few asset classes, let's call it solar, wind, hydro, geothermal, transmission lines, there are many sectors where the insurance industry, frankly, just doesn't even know what they would want. So if you would ask them, if I asked you, hey, what would you want in a perfect direct air capture project that you'd invest in, or CO2 pipeline, or nuclear project, right? Or hydrogen project, I'm not sure And so like, that's something we can help with. There are actual projects that we know about that we could show you, right? Maybe anonymize it because of some of our confidentiality requirements, but we can show you a business model. And we could ask you, hey, what would your thoughts be? What would your due diligence questions be? What, protections would you want from the federal government, either through grants or loans from us or other things, to be able to get you more excited about investing in that asset class? And so I do think that making sure that we have a robust conversation, not only on the risk side, but also on the opportunity side, is going to be important, both for your businesses and for, our ability to, hit our goals in terms of reducing carbon emissions and, reducing the risk of severe weather. So with that, thank you so much for your time today. And thank you, Andrew, for joining me here on stage.
Thank you. Pleasure.
Take care.